The cryptocurrency world is super chaotic every day, but if you're a new investor in the domain, you can make things a bit smoother by avoiding some basic mistakes. But who's holding your hand and guiding you through the process? You may not find many honest people, which is where we come in. Today, let's look at why most people get wrecked by crypto and common mistakes to avoid. Without further ado, let's go. First off, the no diversification issue.
So is regulation the answer here? Can that fix the problem, give crypto a better looking future?
The old financial adage, don't put all your eggs in one basket, rings true here. This advice to spread out one's investments in cryptocurrencies resonates like no other. Look at it this way. The holder of a corporate bond is likely to still receive something back during the liquidation if the issuing business goes bankrupt. Even if the housing market crashes, a house's owner will always have a place to live. Many factors, such as a sudden change in user tastes or a major code-based flaw, might decimate a cryptocurrency's value overnight. This suggests that hedging your bets across two dimensions is a sound strategy. Not all crypto strives to achieve the same thing. Some may be described as payment tokens, having a purpose that is, in the broadest sense, similar to the US dollar or gold. Other tokens might be classified as infrastructure tokens, since their primary purpose is to serve as a foundation upon which decentralized monetary applications can be constructed. So be sure to branch out. Up next, herd buying. Too many rely on, sometimes anonymous, online accounts for cryptocurrency news. Because of this, many people may suddenly support a certain cryptocurrency based almost entirely on the actions of their peers on social media. A poll conducted by the nonpartisan NORC at the University of Chicago said that 24% of cryptocurrency investors get their cryptocurrency news from social media, 26% from crypto exchanges, and 25% from conventional trading platforms like Fidelity and Robinhood. It shows how uninformed many investors are. It's a bad idea to put all your eggs in the social media basket, and herd buying, since the most shared content on these platforms tends to represent confirmation bias. Otherwise, traders risk falling to the temptation to follow the general attitude on social media platforms like Twitter, Discord, Telegram, and others. Adopting a cryptocurrency after it has already gone widespread is like trying to catch a crashed wave. When too many people persuaded by social media purchase at the peak of the Bitcoin market, the price inevitably drops. Moving on, the lack of planning. You should plan how much money you want to earn will determine the level of risk you are prepared to take. When do you want to cash out, either partially or entirely, so that you can reinvest at a cheaper price, or so that you can do nothing at all? What is your time horizon for this investment? How you answer these questions is crucial and should fit your overall investing plan. When buying Bitcoin, for instance, if you want to keep it for the long run, the price you pay makes no difference. If anything can be assured in crypto, its value will increase with time. Following up, the security issue. Remember that cryptocurrency is still unregulated and that you will probably never see your coins again if the government ever bans them. Several phony crypto-influenced accounts are circulating online. Take precautions while interacting with strangers on social media platforms like YouTube, Twitter, Telegram, etc. Trust and investigation are essential before establishing a connection with a business. Many individuals have lost money to this scam since it often consists of very enticing offers that promise to double your crypto in minutes and then vanish. Not to mention, investing in what you can't lose. You should only risk money you can afford to lose on the crypto market. No one enjoys a financial loss. Because of crypto's extreme volatility, you shouldn't expect those incredible profits to come without the danger of equally enormous losses. The more volatility and risk, the smaller the cryptocurrency's market cap. The profit potential is a function of your background and comfort level with risk. Nonetheless, you should know the potential drawbacks and worst-case scenarios. Avoiding these errors is no assurance of financial success, is it? Naturally, that's not the case. However, it might help lessen the danger. Finally, the too much trading dilemma. In a nutshell, some rookie traders have the regrettable inclination to go from one transaction to another on a whim, often following the herd or the latest trend in social media. This implies that those who have one cryptocurrency will trade it in for another token, hoping to make even greater profits, and so on. There is no assurance that the trader will make more money with this method. However, one certain thing is that they will incur more exchange costs with each subsequent purchase. In addition, there's always the chance that they'll sell one token at a loss and another at an even greater loss, so you can understand how quickly the expenses and losses might add up to a colossal yellow avalanche of failure. Again, the key to avoiding this is knowing which cryptocurrencies are the most stable at their core and sticking with them. Don't keep following the herd. And remember, the cryptocurrency market is still in its infancy. Currencies that are only slightly increasing in value now may have appreciated substantially by the end of the next few years, if they have solid bases to build. Let's talk about how crypto rug pull scams work and the warning signs. A rug pull is a sort of cryptocurrency fraud in which the perpetrators artificially inflate the price of their project's token before running off with the money and leaving their investors holding the bag. Rug pulling occurs when dishonest creators launch a new cryptocurrency token, artificially inflate its price, and cash out before its value collapses. Rug pulling is an example of an exit scam and a DeFi vulnerability. Next, going over how they work. Even though rug pulls are clumsy, the con does take some preparation. First, the con artists would register a new coin on the decentralized exchange, DEX. Perhaps some of you have heard of Uniswap or SushiSwap. Users may issue their tokens on these networks without undergoing verifications or audits. It takes a lot of effort to make a new token. Making a counterfeit coin that lasts only a few weeks requires little work. Most of those who engage in rug pulling just copy the code of other currencies and make minor alterations to the information. Imagine rewording a section of Wikipedia by altering only a few phrases. They would then extensively promote the new coin once it was launched and the liquidity pool was full. They would shout from the rooftops about how promising their cryptocurrency is, urging you to get on the bandwagon before it explodes. No one, especially, would pass up the opportunity to become wealthy. To eliminate suspicion, scammers would link the harmful coin with a widely used cryptocurrency like Ethereum. An easy way to win over investors is to use the power of association. When the new coin's price rises high enough, people will start trading for it, and the con artists will quickly disappear when they've drained the liquidity pool. You wouldn't even realize the money has disappeared since everything happens so quickly and quietly. As soon as 4 days after a token went online, there were reports of rug pulls. Not to forget, here's how to avoid rug pull scams. First up, be aware. Investors should think about how trustworthy the individuals behind new cryptocurrency initiatives are before putting money into them. Does the crypto community recognize the creators and backers? When it comes to projects like these, what kind of results have they had before? Is the development team still credible and capable of delivering on their commitments if they have been doxxed but are not widely known? Make sure that you're aware of all this before you proceed. Next, check the liquidity. Verifying the absence of liquidity locks is a simple technique to tell a scam coin from a real cryptocurrency. Without a liquidity lock on the token supply, the project's developers might just steal it. Smart contracts with a time lock ensure that tokens will be exchangeable for at least 3 to 5 years after they are issued. While developers may code within their time limits, using a third-party locker might provide you more peace of mind. Finally, watch out for sudden price rise. Be wary of a new cryptocurrency whose price has fluctuated wildly recently. Regrettably, this is true if the coin has no locked liquidity. When a new DeFi currency's value suddenly skyrockets, it hints that the coin is about to be dumped. If a coin's price change raises eyebrows among investors, they may use a block explorer to verify the total quantity of coins in circulation. Due to the low number of token holders, the token's value may easily be manipulated. Indicators of concentrated holding of tokens may also show that a few whales may quickly and severely devalue the asset by selling off their holdings. That's a wrap for this video. So what did you think about these common mistakes? Did you commit any of them? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you at the next one.